All right, so the topic today talks about how to trade like a pro with chart patterns. Now, I believe the theoretical part of this class has taken place, but then I'll just rush through just to revise, have a little revision with us on the patterns. Then we'll go to the practical. The essence of this class is actually the practical side to it, but then let's just do a little theory. Then we'll check out the practicals. Now, usually chart patterns, they are technical patterns that gives us an insight into the future direction of the price. Like what is written here, a chart pattern is a visual formation or a shape within a price chart that provide clues to what prices might do next. You see, our job as traders, like I always tell my students, our job is to identify the direction where the market is going, and we trade only in that direction. And chart patterns can actually help us to spot the next direction of the market. Now, without wasting our time, I'll just show us the specific patterns we're going to be looking at this afternoon. And we have the double top, the double bottom, the head and shoulder / inverse head and shoulder, rising and falling wedges. These are the most common patterns, not only common, but very consistent patterns that we have in the Forex market. So let's just take a look briefly at each of them. This is the double top pattern. Double top is like letter M, just like you're drawing a letter M. And in that wise, what we're trading is just a breakout of price below the tip, which is called the neckline, downwards. Please, everyone should mute their device. Faith Joseph, kindly mute your device so that we don't have distractions. Thank you. So what we're trading is a breakout of price below the tip, which is the neckline of the letter M. So anytime we say double top pattern, it means we're generating a bearish signal, otherwise called a sell signal. Now, the next pattern after that is the opposite of the double top, which is the double bottom pattern. And here it looks exactly like a letter W. So what we're trading is a breakout of price again above the neckline towards the upside. So a double bottom pattern gives us a bullish or a buy signal. Then we have the head and shoulder pattern, which is formed when price makes a higher high, which is called the head, the second shoulder, and a breakout downwards. And we can make entry below the neckline region also. So for a head and shoulder pattern, it's only going to generate a bearish or a sell signal for you. Then we have the inverse head and shoulder pattern, which is the head and shoulder pattern turned upside down. And that one can give us a bullish signal after price breaks out above the neckline. Then we have the rising wedge, which is a pattern that forms when price is reversing from uptrend to downtrend. So anytime you see a rising wedge pattern, it means we're only looking for a sell or a bearish signal. And we have the double top bottom pattern, which is a reversal from downtrend down to uptrend. So anytime you see a falling wedge, we are only looking to generate a bullish or a buy signal. Now, there is also of note that when you're trading this falling wedge pattern or rising wedge, there's always a breakout candle, which will inform our decision to either buy or sell. Breakout candle is a candle that opens within the pattern and closes outside it, signifying a change in the direction. All right, so these are the three major patterns we're going to focus on in this webinar this afternoon. Now, at this point, I'm just going to go straight to the chart and I'll show you these patterns live on chart. Now, this is a practical session, so we have to do it that way. So let's go. All right, I've marked some of these patterns on certain financial assets. So I'll just show you those assets and you can learn how these patterns work in real life example. So the first one I'm looking at is the head and shoulder pattern, and I'll be looking at the AUDCHF on the 4-hour time frame. All right, so this is the head and shoulder. Now, it should be noted that in real life, some of these patterns may not look as beautiful as what you saw on the training manual. It may not, but with time and with consistency, you can identify them, faster. So this is a head and shoulder. This is a shoulder, a head, a second shoulder. Now, the thing about these patterns is that it can generate very, very accurate signals. And that's why I don't want you to sleep on the class today. It can improve your win rate as a Forex trader. You can see here we have the head and shoulder pattern and we have the neckline region and price broke out below the neckline, and we can see a retracement and a further massive drop on this instrument. That's AUDCHF. At least to the recent low, price generated at least about 70 pips, though much more lower, it generated as much as 90 pips. We just said between 60 and 90 pips was generated with this particular pattern on the 4-hour time frame. Now, most of the patterns I'll be showing you on 4-hour time frame, so I'm just saying that so that you can know. But then you can actually check them on any time frame, but avoid lower time frame like 15 minutes. Sometimes it may not be consistent, though that's subjective anyway. But anything like 1 minute, 5 minutes, ignore those ones completely. Some patterns may still work on 15 minutes, 30 minutes, 1 hour, but anything lower than that, like 1 minute, 5 minutes, just ignore. So this is the head and shoulder on AUDCHF on the 4-hour time frame. Let's check another one. There's also CAT CHF. Now, this one is a bit technical to identify, but I have been doing this for long. I can spot it anyhow it comes on any financial asset. This is a shoulder. This is a head. This is a second shoulder. And we can see a drop. Now, this is the neckline region. And this move generated about 50 pips, to the recent low. Then the next pattern is the inverse head and shoulder. And I'll be looking at the Euro USD. Inverse head and shoulder. Okay, I think I have another Euro USD somewhere. So let me just look for that one. All right, I found it. All right. Now this is the inverse head and shoulder. That's head and shoulder upside down. Shoulder, head, second shoulder, and a breakout. Now here we can see there was a breakout. This is the neckline region. And price broke out, retraced, went up, retraced, went up, retraced. At least it targeted the next high, which is like a resistance zone. Someone is asking if the class has gone far. No, it just started some few minutes ago, so you are still on time. That's Mr. Oguchukwu. You're welcome, sir. Just started like 5 minutes ago. You have not really missed much. We've only touched head and shoulder. Now we're touching inverse head and shoulder, which shows us how price can reverse, from downtrend to uptrend. So while for the head and shoulder pattern, we're looking to generate a bearish signal, with the inverse head and shoulder pattern, we're generating strictly a bullish or a buy signal. And here I'm showing you an example of that. Here, price was able to hit as much as about 100 pips, precisely 111. But let's just round it up to like 110 thereabout, using the inverse head and shoulder pattern. So for those who are just joining, we're looking at chart patterns, how to improve your trade probability, with chart patterns. All right, so we've looked at the head and shoulder. We've looked at the inverse head and shoulder. Now I want to look at the double top pattern. Now it should be noted that the double top pattern looks just like a letter M. And I'll be looking at the GBP AUD for that. It looks like letter M. Now, the truth is that Forex is not complex. It's what you're looking at. You can make it complex. It's a choice. You can also make it very simple. You can see that we're looking at head and shoulder. Now we're looking at double top. Double top is like letter M. Double bottom is like letter W. Now, I want to trade Forex, and I'm looking for the formation on letter M. That's the simplicity part of it. It makes it simple. Anybody can trade. So this is letter M. This is the neckline. Price broke out and continue trending further. And the movement is as much as about 137 pips. Just identifying letter M, Forex is not complicated. Don't make it one. So when we see a double top pattern, we are only generating a bearish signal. And the next one will be double bottom pattern. So while double top will give us a bearish signal, double bottom will give us a bullish signal. And I'll be looking at the USD card for that on the 4-hour time frame. Okay, I think I'm a mixture of double bottom. Let's see. All right, all right. I found it. It's actually the daily time frame, not a 4 hour. This is the double bottom like a letter W, but this is the neckline and price broke out. If our price still went as high as this region, but let's look at something realistic, just a recent high, so that will not be Oliver Twist. Don't need to ask for too much. Now, at that point there, so we're saying that price formed the double bottom pattern, which is like a letter W. This is the neckline, and price targeted the next high, forming a resistance up there. And that generated as much as about 300 and let's just say approximately 300 pips. And that's a whole lot to make a good, a lot of profit in the market. So the bottom gives us a bullish signal. Then we have the rising wedge, and I'll be checking the USDCHF for that, for the rising wedge pattern. Now, this is a rising wedge pattern. It's formed when you connect price to recent, to higher highs and higher low, higher high, higher low, and on like that. Eventually, price will break out to the downside. So for the rising wedge, it's always facing down, always. And you can see this particular one, see the massive movement of pips. Now let me just use my crosshair tool to check. Here, price dropped to the tune of about 381 pips. But then if all we're looking out for is just the recent low, which is this region, that could still generate as much as about 129 pips, which is not bad anyway. Okay, when you're trading chart patterns, it's not compulsory to look for a retest. You are trading a pattern already. It's not compulsory. You can just trade the breakout exactly as it comes. I'm responding to Ajayi Kayode. So that's the rising wedge pattern on the 4-hour time frame. Okay, another example I have here is a Euro AUD on 4-hour time frame. All right, now look at the rising wedge again. This is looking slightly different. You know, it looks like the upper part is really compressed here. And you can see that price still broke out to the downside, generating as much as about 340 pips thereabout. So for the rising wedge, you are connecting higher highs and higher lows, higher high, higher low, higher high, higher low, on and on till there's a breakout to the downside. I think I still have another example of rising wedge. That's the USD card on the 4-hour time frame. Okay, I can't seem to find that, but I've given two examples already on the rising wedge. So we want to check the next one, which is the falling wedge pattern. And I'll be looking at the Euro NZD. Fresh UC, please mute your mic. All right, so we'll look at falling wedge, Euro NZD. On the 4-hour time frame, we're checking out the falling wedge. All right, so this is the falling wedge pattern on the 4-hour time frame. You can see price is making a series of lower highs and lower low, lower high, lower low, then a breakout to the upside. And you can see at the point of breakout, you can see price went as high as 266 pips. That's a whole lot. That's really massive. I have another example of falling wedge, NZD USD. Can see it here also. Lower high to lower low, lower high, lower low, until there's a major breakout. And here price went as high as about 320 pips. So this setup, they are very, very powerful. It can change the game for you. I must confess, it actually changed my game as a trader. So it's what I can recommend that you use. Apologies for the little break. So these are the patterns. A little recap for those who joined us late. We're looking at chart patterns, and these are patterns that are, that you can see on the charts that can point you to the next direction of price. I've mentioned some patterns. I talked about the double top, double bottom, head and shoulder, inverse head and shoulder, rising and falling wedges. And I tell you, these are powerful. If you have not been using them, learn to start using them from today. Now, before we close, I want to show you something important. Now, there are some times when some of these patterns, especially double top, double bottom, or head and shoulder, inverse head and shoulder, we may end up finding them within a rising or falling wedge. And that increases the probability, the chances of that trade becoming more successful. Now, I'll show you two examples of that. I have one on Euro USD. Okay, let me start with the USD card on the daily. USD card on the daily time frame. All right. Now this is USD card on the daily time frame. This is a rising wedge pattern. But within now, why is it rising wedge? Price makes a series of higher highs, higher low, higher high, higher low, on and on and on and on like that. But what even made it to break out eventually was because there is a head and shoulder pattern within the rising wedge. Now, this increases the probability of this rising wedge to way like 99.9% probability. It's never going to fail. And price broke out, retraced, continued further downwards. So anytime you see a chart pattern within a rising wedge or falling wedge, just relax. That trade is likely never going to fail. I can tell you that. So I'll look at another example here now, and that's Euro USD on 4 hour. All right, so this is Euro USD. Falling wedge slash inverse head and shoulder pattern. Now, this is Euro USD on 4 hour. We have a falling wedge, price making lower highs and lower lows. Now, the tip here, now on 4 hour is not looking too clear, but I tell you that this is an inverse head and shoulder. You can as well take it down to 1 hour. So let me mark that region now. We now go to the 1 hour time frame. All right, so on 1 hour, this is a shoulder, a head, a second shoulder, and a breakout. There was a retracement, another eye, on and on like that. So when you have a rising or falling wedge and you have within it, especially at the breakout, at the point of breakout, a head and shoulder, inverse head and shoulder, right, double top or double bottom, it can signify the breakout of, a very high magnitude breakout of price. You can see price movement going as high as 435 pips. Way, way, way good trade right there. All right, so that'll be all from my end this afternoon. I'm seeing a question. If you have any question, you can go ahead and ask. I'm right here to attend to you. All right, Sam Kayode is asking, how do we apply them to recent current prices. I can see these are previous ones. Of course, these are going to be previous ones now. They are chart patterns. It takes time to form. So it's like having several candles forming a pattern. Definitely, it's going to take time. If I see a recent one, sure, I'll show you. But now, these ones are past. I think there's a couple of one or two. Let me see. Okay, like now, there's a falling wedge that broke out this week. I'm going to show you that one now. On That's a NAS 100. All right, so let's check. All right, so this is NAS 100. You can see this is a falling wedge, and price broke out to the upside. You can see that generating about 480 pips. This happened this week. Let's check out the date. This is the breakout point. Date was February 2026, 24, which was yesterday. 15 hours. 15 hours should be 3 p.m. Nigerian. Okay, that's about 2 p.m. Nigerian time because the server time is 1 hour ahead of our local time. That's 2 p.m. yesterday. This broke out, and it's still, well, I can't tell you it's still running now because I don't know whether it's going to go higher beyond this level. But the fact is that it generated over 400 pips between yesterday and this minute that we're speaking. What you need to do is to first identify the pattern. If it's a rising wedge, can you find a pattern where price is making a higher high and higher low? If it's a falling wedge, is lower high, lower low. If you've joined the classes on characteristics of price, it will help you a lot in drawing rising and falling wedges. You're only looking for higher high, higher low for rising wedge, lower high and lower low for falling wedge. For double top, that is like letter M. You don't need anything special. Just identify a pattern that is forming letter M. You are just for double top is letter M. For double bottom is letter W. For head and shoulder, it's like a head. As a human being, we have a head and we have two shoulders. So head and shoulder will give you a bearish signal. Inverse head and shoulder will give you a bullish signal. You with practice, what I will encourage you to do is that after this class, try and watch the video over and over again and try looking out for these patterns on the charts. At least on 1 hour's time frame, you can start. You'll see quite a number of them. If you identify this chart pattern, can we go ahead and set pending order? I would say pending order wise, restrict that to just double top, double bottom, head and shoulder, inverse head and shoulder. For rising wedge, better you let it break out. Except if at the point of breakout, you have a head and shoulder or a double top or all those patterns, fine. But if you want pending orders, yes, you can use that on rising wedge. Sorry, you can use that on head and shoulder, inverse head and shoulder, double top, double bottom. Let me go back now and show you examples. Let's check double top GBP AUD on 4 hour time frame. All right, so this is GBP AUD on 4 hours. So how do you set pending order for this? Okay, now if you want to set a pending order on this is the double top. You first identify the area that is called the neckline. That's the tip of that setup. Now, usually we have a kind of a fake out here, but then that's for convenience. The tip of the candle, usually the shadow, that is when you set your sell stop order. For double top pattern, you are using a sell stop order for double top. For double bottom pattern, you are using a buy stop order. So just set your pending order as price is coming down. It will trigger it automatically on its own. So for double top, double bottom, head and shoulder, inverse head and shoulder, yes, use your pending order. If I is far safer to use your pending order to trigger this particular setup. So that's double top. Let's look at double bottom, USD card 4 hour. Okay, this is the double bottom, USD card 4 hour. Again, price is moving. Again, we have a neckline. the tip of the candle around the neckline, you put your buy stop order there. Price will automatically trigger and move upwards. Now for head and shoulder, let's check out the example for head and shoulder. For head and shoulder, we'll look at AUD-CHF, right? So let's check AUD-CHF. So for head and shoulder, shoulder, head, second shoulder, the neckline. Now, okay, in this case, we don't really have a clear-cut wick. So in such instance, what do? We may just randomly take like 5 pips below the recent low on the chart, which is around this region, and you can set your sell stop order so that once price gets to that level, it automatically triggers. And I can see there's a trigger, a retracement, and a further continuation. So that's how to set your pending order for. Let's check inverse head and shoulder Euro USD. Okay, 4 hour. All right, so this is inverse head and shoulder. You can see shoulder, head, second shoulder breaker. In this case, just the tip here becomes your buy stop order. Price will trigger and continue going. So that's how to set your pending order for both double top, double bottom, head and shoulder, inverse head and shoulder pattern. All right, Issa is asking, when drawing trend lines, do we necessarily have to consider the wicks? I believe you mean the shadows, still the same. Well, my own answer to that, like some trainers will tell you that if you're drawing trend lines, your trend line has to be at the tip of you'll be connecting just the tips of the shadows. For me, from my experience in trading, no. I believe your trend line should rest on the body. It may touch the shadow. Now look at this particular trend line. Now, if all what you want to do is to consider the shadow alone, we may not get the accurate movement of price. And as a confirmation to what I'm saying, let's make the trend line to touch the body of the candles. So we have trend line touch 1, 2, and 3. Now, if you go to the line chart tool, line chart gives us a clearer view. You see that price is actually close to the body of the candlesticks. The shadows are important because they show us areas of rejection, but the trend line is more powerful around the body. So not necessarily the tip, because the tip of the candles will not always align. That's the truth. The tip, as in multiple tips, will not align. But most of the time, at least you have 2 to 3 of the body aligning when you're drawing a trend line. So I believe it should more touch the body, while the shadows can just be a complement to the whole setup. All right, I believe that answered your question, AC. All right, any other question? Okay, so while we're waiting for any other question, don't forget on Friday, we're going to be having a webinar on fundamental analysis, how to turn global events to profitable trading opportunity. We're going to be dropping a link from maybe this evening or tomorrow morning. Just make sure you join us on Friday. You're going to learn a lot on fundamental analysis and how to trade global events. You know, a lot of global events happening around us every day. You know, US is causing so much around the world today. How does those speeches made by someone like Donald Trump, how does it move the market? And how can you take advantage of such moves to make money? How do we interpret economic data like NFP, CPI, and how can we interpret it to trade and make money? You know, we've been doing some of our live sessions. If you have joined us, we're going to show you how we do all these things so that I can do it independently on your own. Don't forget, this is PU Prime, and one of our main goals is to educate you on how to trade Forex because we believe knowledge is power. If you have the knowledge, you can take a trade by yourself and make a lot of money in this market. Okay, I'm seeing so many other questions here. Okay, let's see if I can attend to you. Where can I watch other videos? You need to subscribe to our YouTube channel. Now, at the end of this class, I will drop the video to this particular session. You can watch it, but better still, when you click on it, it takes to YouTube. You can subscribe to our YouTube channel there, and you see tons and tons of videos, analysis sessions, live trading sessions, webinars, and many others. I tell you, there are thousands of hours of content that you can consume on our YouTube channel. Ugochukwu, is flag, pennant, cup, and handles important? Well, the truth is that they don't occur too often, especially pennant, cup, and handles. They really don't show up too often in the market. That's why my focus here is patterns that are more consistent and you will see more often. Cup and handle doesn't, it rarely shows up. You know, it's not a very common pattern like that. And likewise, pennant. You will see, before you see all these flag pennants, cup and handles, you'll have seen tons and tons of head and shoulder. But rising wedge is the most common. Is the most common pattern. Rising wedge, falling wedge, followed by head and shoulder, inverse head and shoulder, then double top and double bottom. Those are the three most common patterns you will find more often every time you check your chart. So it's better to focus on the few that are more consistent, you know, and you see more often than the ones that show just once in a blue moon. I hope that answered the question, Mr. Gochuku. All right, with that, we'll come to the end of this webinar this afternoon. Don't forget, once I drop the link, take your time to watch the video and you know, get better insight to what you have thought. All right, I'll sign off here. Take care and enjoy the rest of the day. Bye-bye.